Now, let us start with the theory of the cost. And before we talk about the analysis of the cost, let us first talk about certain aspects of the cost, like we have the opportunity cost. Now, opportunity cost means the cost of the next best alternative or next best opportunity. Now, let us say, for example, I am a fruit grower. If I process this fruit in my own factory, the opportunity cost for this fruit grower will be the price that this fruit can fetch in the market. Now, these types of the costs are not actually recorded in the books of accounts, but they do have implication when we talk about the analysis of the cost for a firm. Not recorded in the books of accounts. Now let me consider an example. Say for example we have this Mr. X. Now what does this Mr. X do actually? He has, say for example, this $1,000. Now what he actually essentially does, he essentially has three opportunities. He either can invest the amount into the bank, or he can loan it to a friend, or he can go and invest in his business. Now say for example this bank is going to provide him an interest rate of $100, and this friend is going to give him an additional amount of say for example $150, and if he goes for the business he is going to earn some $200. Now the best opportunity over here is 200, so he's going to split this, but the opportunity cost is going to be $150. Now because this is the next best opportunity, since he invested into its own business, so he is gaining 200, but he is losing the 150 next best opportunity. The net difference is $50, which is also known as marginal gain. Since the opportunity in which he invested is giving him more returns as compared to the next best opportunity, so he is on the marginal gain. Now suppose if he somehow he did not invest in his own business but gave the money to the friend, so he got the returns of 150, but he has lost the opportunity of losing into his business. In this case he has a negative marginal loss, which means because he is investing into an opportunity that is giving him less returns as compared to one that could have given him more returns, so in this case he is on the marginal loss. Now the second concept that we are going to talk about is the accounting cost. Now accounting cost means whatever the a firm or any business house actually pays out of its own pockets, that is actually paid. Now some examples of it can be like the business pays for the rent, it pays like the electricity bills, it pays wages and salaries. So all of these are actual costs that this firm is actually paying for conducting the operations. In this case, all these costs will be actually classified as the opportunity cost, And now opportunity cost, can be classified as accounting costs. Now these costs are actually recorded in the books of accounts and are actually actual costs that you can see on the income statement of any firm. Now, these accounting costs are sometimes also called as explicit cost. Now, the third type of the cost that we will talk about over here are the economic. Or before we talk about the economic cost, let us talk about what are implicit costs. Now, these implicit costs have to clearly do something with the opportunity costs. However, there is it's slightly a slightly different concept because it is something that is the cost of self-owned inputs in the production. Now, I know that the factors of production can be inputs to the production or the factors of production. They can be like land, labor, capital, and manager. Now, if someone owns these factors of production, but actually, say for example, a person owns the land and he actually uses the land to carry its own operations, or he himself goes and works into that business, or he gives the capital to that business and then manages the business himself. So in this case, he is losing the opportunity of giving this land to on the rent. He is losing the opportunity of working somewhere, and he is losing the opportunity of investing his capital. In this case, such costs are known as the implicit costs. Now, if I am using my own asset, my own factors into my own business, and then losing on such amounts that could have been invested in some other business and could have fetched some other amounts in some other businesses is known as an implicit cost. Now let me consider an example over here. Say for example, giving I am running a business and I use my own land for business. Now, if I use my own land for my own business, the rent that this land could have fetched, if this land had been rented, this will be an implicit cost. Now, the economic costs consider both the explicit costs plus the implicit costs. Now in this case, the economic cost now is comprises of both the accounting cost plus the implicit cost.